I'm Paul Whitburn, Portfolio Manager and Analyst at RECM. Today we're going to be discussing the first quarter of 2014, and I'll be running you through the local equity fund, the local balanced fund, and then also our global fund. To start off with local equity, we've seen a continued underperformance in the local equity over the last quarter, and this is really as the benchmark, which is driven by large stocks such as Naspers, South African breweries, British American Tobacco, MTN, and Richemont have continued to perform well, while a large portion of the positions that we own in the resource sector have lagged the market. This is not a case of concern for us. We believe that the businesses that we own, specifically in the platinum sector, are high quality businesses and trading at a substantial discount to the intrinsic value. So we continue to be happy shareholders in these underlying businesses, notwithstanding the strikes that are currently ongoing in the South African platinum industry. And in fact, we think that this is a good result in the sense that the platinum miners are taking a stand against the workers, and they realize that they need to generate economic returns for their shareholders to keep their businesses sustainable. So this is an important inflection point for the industry, and we're actually excited to see what the outcome would be. The fund is currently trading at a discount to fair value of 21%, which is not particularly cheap. Having said that, we have found other positions that are particularly cheap in the financial services businesses such as Able, Capitec, also a new position that we've bought into the fund, and Barclays Group Africa. And then of course our large position in Standard Bank. So what we've seen in that sector of the market is that the unsecured players such as Capitec, Able, and to a smaller extent the large banks have been affected by the slowdown in unsecured lending, and we're finding that these businesses are trading at a substantial discount to their intrinsic value, and we've slowly been buying some positions in these underlying businesses for the fund. The other sort of industry that we've been buying is in the construction side of things. Avenge is a new name that crops up in the portfolio, also trading at a substantial discount to intrinsic value. They've had a really tough time in the local construction industry, as we've seen with the slowdown in infrastructure development. But we believe that with the new management team who are now focused on generating returns for shareholders, that this may slowly change, and they've got a very successful offshore business that will continue to drive earnings for the business. To move on to the balanced fund, I'd just like to point out the capital allocation of the fund at this point. Currently, the fund has a 50% exposure to local equity. That is, of course, predominantly populated with resource companies, the likes of Anglo Platinum, Impala Platinum, Lonmin, Anglo American, businesses that we view as high quality and trading at a substantial discount to fair value. The other side of the portfolio that we have been investing in is within the industrial space, has been Avenge and the construction counters once again, and then also some businesses in the unsecured space, where we large shareholders in Able, JD Group. The JD Group situation changed somewhat in the first quarter of this year, with Steinhoff making an offer to minorities. We did not accept this offer and remain shareholders in the listed JD Group business, and we look forward to working with Steinhoff management to turn this business around. On the bond side of things, we remain underinvested in bonds, specifically South African sovereign bonds. The only bonds that we do hold in these funds are Able corporate bonds, which were priced to have equity type returns at a period in the market where not a lot of people were interested in Able paper, but we think that this business has de-risked itself substantially due to the substantial rights issue that it underwent late last year. On the property side, we have very small investments in the property market. This is particularly relates to a small position in HPB, Hospitality B units, which is really a hotel and leisure business and not your sort of run-of-the-mill commercial property business. The balanced fund is now trading at a 20% discount to fair value, but the equity component of the balanced fund is trading at a 25% discount to fair value, which is a substantial discount, showing you that the businesses that we do own in the equity carve-out of this balanced fund are trading at substantial discounts to fair value. And then finally, the global fund. The global fund itself has had a fantastic first quarter, and this has really been driven by great returns from one of our largest positions, Ultra Petroleum, and then also Anglo Platinum, that has had fantastic returns locally, but also with the strengthening rand in US dollar terms, it has done even better. So we've seen that fund return just over 5% for the quarter, while the MSCI World has been flat. We're very excited about the positioning of that fund, where we own predominantly European cyclicals. The US is still our largest market where we're invested in, and that's specifically UPL, which is the natural gas producer. Some old school technology firms, Microsoft, Intel, HP, and the like. Also the US banks. And then a position in the Ichirizuka Master Fund in Japan that has also done fantastically well. The global fund itself, many of the positions there have run up with the world markets over the last year and 6 months. So we continue to take some money off the table. Cash positions have increased close to 20% for the fund. And currently the investment team is very busy with new ideas to populate the portfolio and going through the due diligence process. So we're very excited about some of the new positions that will probably come up in the portfolio over the next year.